Today of Watchdogs and Lapdogs. The DFA Daily to the 16th of September 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show we look at liar loans, the rise in hardship loan assistance, criminal charges at ME Bank, the trophy homes boom, and ASIC turning from a watchdog to a lapdog. So let's get started. Australian home prices have spiked nearly 20% in the past year, and investment bank UBS has warned that a record level of liar loans could be one thing driving the surge. An annual UBS survey of around 900 people who took out a mortgage over the past year showed that 41% submitted loan applications that were factually incorrect, according to ABC News. That's a record high in the 7 years UBS has collected the data, up from 38% last year and 27% when the survey began in 2015. There was a brief dip in liar loans during the Banking Royal Commission hearings in 2018, a time when banking and financial regulators were coming down hard on risky lending. While the majority of those who submitted inaccurate information said their loan applications were mostly factual and accurate, just under 1/3 said that their application was only partially factually and accurate, another record high. The most common area of inaccuracy were underrepresenting living costs at 34%, underrepresenting financial commitments at 28%, and overrepresenting income at 22%, according to the research. The size of the misrepresentations also increased this year. Of those who overstated income, 36% did so by more than 25%. 29% of people who understated their living costs did so by more than 15%. And UBS said the increasing risk of home lending was best illustrated by a record rise in very high debt-to-income mortgages. Amid home prices booming 18.3% year over year, that's the highest since 1989, we think borrowers are chasing the market and stretching towards their capacity limit to be able to qualify, UBS said in its report. And as has been the case in previous UBS surveys, borrowers who used mortgage brokers were far more likely to submit inaccurate applications at 44% than those who applied for a mortgage directly through a bank at 29%. In the vast majority of those cases, borrowers said the mortgage broker advised them to lie on their application. Property investors were also more likely to falsify their loan applications at 53% for those with one investment property and 57% for those with two than were owner-occupiers at 31%, according to the survey. Buyers of rural and regional property were also more likely to have lied on their applications. Elsewhere, more than 57,000 customers have received hardship assistance during recent lockdowns across Australia, including more than 30,000 loan payment deferrals on home and business loans. New statistics released by the Australian Banking Association showed hardship assistance, which includes deferring credit card payments and waiving fees and charges, has almost tripled over the past month, up to 57,000 from 20,000 last month. Home loan deferrals have grown to more than 27,000, up from 14,500 last month, while deferred business loans also increased to more than 3,500 from just 600 in the same period. Comparatively, this is still significantly below the peak assistance provided in 2020, which saw more than 1 million home and business loans deferred. Anna Bligh, Chief Executive Officer of the Australian Banking Association, said while the majority of hardship approvals have come from New South Wales and Victoria, customers are reminded not to tough it out on their own, no matter where they live. As lockdowns continue to be extended across cities and states, it is no surprise more strain is being put on people and businesses. But it is important to remember that banks are here to help, Ms. Bligh said. Over the past month, we've seen a substantial rise in business owners putting their hand up for assistance, and I encourage anyone else who is feeling the strain to do the same. Support is available to all small business and home loan customers significantly impacted by current lockdowns or recovering from recent lockdowns, no matter where they live or their line of work, she said. The majority of customers taking up hardship and deferral assistance continue to be located in New South Wales, though more than half of all hardships, at 57%, housing deferrals at 69%, and business deferrals at 72%, were located in New South Wales. Home loan deferrals continue to be the most common type of deferral provided to customers, with 88% of all deferrals relating to home loans. And banks have dedicated hardship teams who can have a range of options available to suit customers' needs. The sooner you talk to your bank, the sooner they can help you find a solution that is right for you, Ms. Bly said. And I would make the point that banks are being more picky this time in terms of when they do provide support. So that's one reason why the numbers are a lot lower. Now, ME Bank is facing criminal charges relating to home loan communication issues, but that was before it was acquired by the Bank of Queensland. A total of 62 charges have been laid against ME Bank, 44 of which relate to letters issued to home loan customers between September 2016 and September 2018. ASIC has claimed the letters made false and misleading representations about customers' relevant annual interest rates and/or the minimum repayment to be paid after the fixed rate period expired and/or the minimum repayment to be paid after the interest-only rate period expired. A further 18 charges relate to ASIC allegations that between December 2016 and February 2018, ME Bank failed to give written notice to home loan customers that their annual interest rates and minimum repayment amounts were changing after their interest-only rate or fixed rate period expired. The regulator reported the alleged misconduct occurred due to failures in the bank's systems and processes. A spokesperson for ME Bank's parent company, Bank of Queensland, confirmed that there had been a case management hearing on Tuesday over the alleged contraventions of the ASIC Act and the National Credit Code. ME Bank had self-reported the issues to ASIC in October 2018 and paid remediation to all affected customers in 2019, totalling $105,000. Bank of Queensland Group was aware of this matter during the due diligence process for the acquisition of ME Bank, the spokesperson said. As these matters are before the court, Bank of Queensland Group does not intend to comment further at this time. ME Bank also became part of the Bank of Queensland Group in July under a $1.3 billion acquisition. The case is the first criminal prosecution under Consumer Protection Provision Section 12DB of the ASIC Act. Under the law, making false and misleading representations to customers with respect to the price of services in connection with the supply of financial services is an offence. The maximum penalty ranged from $1.8 million to $2.1 million at the time the conduct occurred. A credit provider's failure to notify customers of interest rate changes or repayment rates is also considered offences under Section 64.1 and Section 65.1 of the National Credit Code. The maximum penalty for the breaches range from $90,000 to $105,000 at the time the conduct occurred. ASIC originally filed the charges in the federal court in May, and it's been prosecuted by the Commonwealth Director of Public Prosecutions following an investigation and referral by ASIC. The matter will return to court on the 3rd of November. Last year, ME Bank faced criticism when it reduced the amount borrowers could redraw from specific legacy mortgage products without forewarning customers. The policy decision was met with a backlash from customers, brokers and the broader community. In response, ME announced that it would review its decision in consultation with affected customers before revealing that it decided to change back home loan withdrawal limits for any customers who wish to opt out. Following on from that controversy, the former Chief Executive Jamie McPhee was called before the House of Representatives Standing Committee on Economics for an urgent public hearing on the matter and acknowledged that while the decision was poorly communicated, he added that he believed the bank made the right call. "We absolutely believe that the decision we made was the right decision because we want to make sure people don't inadvertently overcommit," he said. "We think it's the right decision, poorly communicated." In July 2020, McPhee announced he resigned from his role, with the bank's chief financial officer, Adam Crane, stepping in before taking on the role of CEO on a permanent basis in December 2020. Now, the AFR reported that wealthy buyers snagged a total of 858 trophy Sydney homes worth at least $2.57 billion during the second quarter. That's the highest turnover on record as business conditions strengthened and the number of ultra-high net worth individuals grew across the country. Across Sydney's prime regions, which includes the CBD, eastern suburbs, inner west and lower North Shore, sales volumes for homes worth between $3 million and $10 million climbed by 23% from the previous quarter, according to Knight Frank. Fortis number 1 Carlisle development in Rose Bay in Sydney's eastern suburbs sold out 7 months before completion amid strong demand for luxury apartments. During the same period, the sales turnover for super prime properties, homes that are worth more than $10 million, jumped by 92% in the second quarter, recording 73 sales. 4 consecutive quarters has delivered record sales volumes for Sydney's prime luxury market, with very little new supply in the pipeline, said Frank Knight Australia Head of Research Michelle Chesuzuki. As prices continue to climb, Sydney is expected this year to hold the title for the strongest growth across major global cities. In Melbourne, 222 premium homes worth around $666 million have changed hands during the same period, a 24% quarterly rise. The number of homes sold for more than $10 million also climbed in the past 3 months, rising by 42% to 17%. Sales for Brisbane's premium homes, worth between $2 million and $7 million, rose by 42% to 198 in the second quarter, and it grew by 11% to 205 in Perth. Across the country, a total of 1,753 luxury homes were sold during the same period. That's an increase of 23% from the previous quarter. Australia's major cities experienced their third consecutive quarter of highest growth on record, prime residential sales volumes, they said. The razor-thin number of property listings has significantly pushed up prestige prices. Mossman rose to the top of home buyers' most wanted list despite the multi-million-dollar price tags. And in the past 12 months, Sydney premium home prices have risen by 6.5%. It rose by 3.6% in Melbourne, and it's up by 5.8% in Brisbane, and by 8.9% in Perth, and by 7.5% on the Gold Coast. The low level of listings has turned buyers towards luxury apartments such as the number 1 Carlisle development in Rose Bay in Sydney's eastern suburbs, said Charles Mellick, director of the developer Fortis. Demand for luxury apartments is very strong, he said. Houses are getting increasingly expensive to purchase, which will have a knock-on effect on the luxury apartment sector, especially for apartments that offer house-size proportions. Fortis number 1 Carlisle development was sold out 7 months before completion, with the average sale price of the 8 luxury apartments sitting at around $5 million. We completed another project, the Benson in Rose Bay, last year, and the demand we witnessed for it was unprecedented, Mr. Mellick said. When we launched number 1 Carlisle, we were confident that the response to this project would be equally strong, and we expected that it might sell out quickly, as it is in a prime location in Rose Bay. It's a short distance from Rose Bay Village and also close to a range of other amenities. The development itself offers a high level of finish and a beautiful design. Each apartment is spacious and offers house-size proportions. To which I would reply, this is one of the reasons why average home prices are so high at the moment, because of course the top end of the market has been very strong, and that is spilling down into the other sectors too. But you've got to compare the total volume with all volume of sales, and in fact it does distort the numbers. Finally, Andrew Shumaloff, senior lecturer at the Faculty of Law at the University of Wollongong, wrote in the conversation that ASIC is now less a corporate watchdog and more a lapdog. The implosion of Australia's corporate watchdog, the Australian Securities Investment Commission, under the federal government's new directions, has gone from tragedy to fast, he wrote. ASIC was described as weak, hesitant and timid in a 2014 Senate review of its performance. To be fair, that was before ASIC's current leadership. Now, any assessment could add dazed and confused. Last week, we got a dose of that in the doublespeak of ASIC's new chair, Joseph Longo, and Deputy Chair Sarah Court in their first significant media interview with the Australian Financial Review. The pair were asked about ASIC's commitment to the why not litigate approach recommended in 2019 by the Hayne Royal Commission into Misconduct in the Financial Services Industry. Following the litany of revelations where the corporate regulator had failed to take action against illegal behaviour, Royal Commissioner Kenneth Hayne made it clear that when ASIC saw a law broken, its obligation in deciding on our response was to ask first, why not litigate? I love litigation, Longo told the AFR. It's what I used to do, and Sarah is an expert at it. But at the same interview, Court, ASIC's head of enforcement, said the why not litigate strategy had had its day. Confusion is to be expected when a regulator is told to both enforce and refrain from enforcing the law, which is effectively what the federal government did last month in the Statement of Expectations it handed to ASIC. The previous statement, issued in 2018, began with acknowledging the independence of ASIC and its responsibility for market conduct regulation. The new statement begins by saying ASIC is expected to identify and pursue opportunities to contribute to the government's economic goals. ASIC accepted the Royal Banking Commission's Why Not Litigate recommendation in 2019, but the federal government's view of this was underlined last Friday when Longo fronted the House of Representatives Standing Committee on Economics. The committee's chair, Tim Wilson, slammed the Why Not Litigate approach as binary, wrong-headed and farcical. And he also disputed that ASIC was too close to regulated companies, despite the overwhelming evidence to the contrary. The answers Longo and Court gave the AFR also suggest that ASIC is backing away from the Hayne Royal Commission's recommendations on enforceable undertakings, by which transgressors negotiate a settlement without admission of wrongdoing. A regulator might think using enforceable undertakings was better than taking a company to court, Commissioner Hayne said in his final report, but that view cannot be formed without having first given proper consideration to questions of deterrence, both general and specific. A regulatory response to a breach of law that does not deter, generally and specifically, will rarely be a more effective regulatory outcome. My own view is that an enforceable undertaking can be completely appropriate in the right circumstance. Infringement notices can be completely appropriate. The impression gained is of an attempt to pay some lip service to the Royal Commission, but also demonstrate fealty to the federal government. The federal government repeatedly resisted the Royal Commission, then backed away from its commitment to act on all the recommendations. What has changed since the Royal Commission? Not much. Last week, the federal court fined Westpac $10.5 million for deceptive behaviour towards members of the Westpac-owned BT Superannuation Fund, a ruling stemming from litigation initiated by ASIC in 2016. This is the same BT ordered 2 weeks ago by the Australian Prudential Regulatory Authority to advise about 500,000 members of its retirement wrap fund that they should leave the fund. So bad have their returns been. In his judgment, Justice Michael O'Brien criticised Westpac for failing to fix its compliance failures, tardiness in compensating customers, and a lack of apology. Westpac has not expressed regret for the conduct, does not appear to have taken steps to remedy the compliance deficiencies, and has been tardy in progressing a remediation plan. At least, though, ASIC litigated against Westpac, successfully pursuing an appeal when it lost its first case. What chance would there be of achieving a fair outcome for consumers from a no-regrets Westpac had it not gone to court? Not much. Australia's battered and bruised financial consumers have every right to say to the regulator and the government, enforce the law or get out of the way. Spot on. ASIC is losing all of its mojo and is being forced essentially into the corner to be a lapdog, not a guard dog. And that is a real problem because there is nobody really looking after the backs of consumers. And in this current environment where people are being enticed to get bigger mortgages and maybe even tell porkies on the way through, appropriate protections are really important. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.